Hello and welcome. In this video series on stock market for beginners, I will be teaching you the basics of the stock market, assuming that you know nothing about it. We will start from the basics and slowly work our way up to the intermediate and advanced levels. And by the end of this course, you will understand what a stock or a share is, why we need a broker, what exchanges are, how the price of a stock moves, how to buy and sell stocks, and much more. Alright? In simple words, you will learn how the stock market works. Alright? Now, an important thing to note is that the concepts that you learn in this video series are applicable to all stock markets across the globe. So what you learn in this video series will hold true even if you are from a different country. Alright? So let us start the video series with the first question. What is a share? Alright? To answer this question, I will take the help of two stories. A short story and another one, a longer story. Okay? So let us start with the short story. There is this boy who has made a pizza. Okay? This boy has made this pizza. It cost him 100 rupees to make this pizza. And what he does is he makes 10 slices out of it. Okay? Now this boy doesn't need all the 10 slices. So he decides to keep 6 slices for himself. Okay? So that is worth 60 rupees. 10 rupees per slice. Okay? And then he decides to sell the remaining 4 slices. Now let us say that this boy has 2 friends. Okay? This boy can buy all 4 slices of pizza for 40 rupees. Or this boy can buy 2 slices and this boy can buy 2 slices. Or this boy can buy 1 slice and the other boy can buy 3 slices. Alright? So there are 4 slices available to buy at a rate of 10 rupees per slice. Okay? So this is the first story. I will come back to this story in the middle of the second story. Okay? So let us start our second story, which is about 2 friends. Okay? So these 2 are friends. Okay? One fine day, these 2 friends decide to start a business. And since they know about coconuts, they decide to start an oil mill, a coconut oil mill. Okay? They decide the name of their business also. they decide to keep it as Oli or name their business as Oli. Alright. Now, when we say an oil mill, it needs a piece of land. It needs a building. It needs machinery. It needs coconuts and a few other things. Right? So there are expenses. And for initial expenses, let us say that they borrowed money from the local bank and then started their business in a small space. The business makes coconut oil from coconuts. Okay? They buy coconuts from the farmers and make oil out of them and then sell it to other customers. Alright? Now, the business is successful. After some time, people start to buy from their shop, and those who bought from the shop start recommending them to their friends, and so on. However, they make little profit because all their earnings are invested back into the business, since the customers are increasing and they have to meet the growing demand. Also, they have to pay back the loan that they had taken from the bank. So 5 years later, the loan is paid off and the mill is earning a profit of 10 lakh rupees per year. Okay? The mill is making a profit of 10 lakh rupees per year. Now, if you have a pen and a paper, go ahead and grab them, because I am going to explain this using some basic math. Don't worry, I am not going to go too deep. We will keep the numbers small and the math simple, so you can follow along easily. Okay? And the mill has a book value of 20 lakh rupees. Now, what is a book value? Book value is the net value of what the company owns. Okay? So what does the company own? Or what does the business own? The business owns a piece of land. Correct? It has some value. The company owns machinery, which has some value. The company has buildings, which has some value. The company has equipment and furniture, which has some value. Correct? These are basic things. I have not considered many more things here because I do not want to confuse you. Alright? All these things have some value, and the value of these is 20 lakh rupees. Okay? So the book value of the company is 20 lakh rupees. Now this doesn't involve any loans. Okay? The value of these minus any loans is the book value. Alright? Next, since their business was a success, they want to expand their business and plan to open 3 more branches in different parts of the city. Okay? After a detailed study, they find out that it is going to cost them over 75 lakh rupees to open the 3 branches, or in other words 25 lakh rupees per branch. Okay? To find this 75 lakh rupees, they have two options. One is to take out a loan from the banks. Banks are ready to give loans. Correct? Or they can sell a part of their company to outsiders. Since the interest rates of the banks are high, the friends decide to sell part of their company to outsiders. Meaning, they want to take the second option. Okay? Now, the big question is, at what value should they sell part of their company? To determine this, they consult an expert known as an underwriter. Okay? The underwriter's job is to professionally value a company. After analyzing Ollie's past performance, assets, and future growth prospects, the underwriter concludes that the company's value is 20 times its current annual profit. Okay? Now, the current profit is 10 lakh rupees per year. Correct? This is from the first branch, main branch. The underwriter says that the value of the company is 20 times the current profit. So 20 times 10 lakh rupees is 2 crore rupees. Okay? 2 crore rupees. So 2 crore rupees plus 20 lakh rupees. What is this 20 lakh rupees? This is the book value. Correct? So 2 crore rupees plus 20 lakh rupees gives us 2.20 crore rupees. Alright? So according to the underwriter, this is the value of the company. Okay? Now, the friends decide to keep 60% of their company. Okay? I will come back to this concept later. Do not worry. Okay? They decide to sell the rest 40% to the public. They want to raise money, correct? They want to raise money to start 3 more branches, right? So they decide to sell 40% of 2.20 crore to the public, which comes to 88 lakh rupees. Alright? Now, let us go back to our pizza example. So this boy who owns the pizza, has cut it into 10 equal parts. Correct? He decided to keep 6 slices for himself and sell 4 slices to his friends. Right? In the same way, the friends decide to split the company into 1,00,000 shares or 1,00,000 pieces. Okay? I will come to what shares are later, but for now, let us continue with the story. The friends decide to split the company into 1,00,000 shares or parts, just like the boy split the pizza into 10 slices. Okay? Out of the 1,00,000 shares, 40%, which is 40,000 shares, are available for the public to buy. Okay? So these many shares are available for the public to buy. Now comes the next question. At what price? At what price can the public buy these shares? The price at which they give to the public is called the issue price. Alright? 88 lakh rupees was our calculation. If you go back, you can see it. Okay? So 88 lakh rupees divided by 40,000 comes to 220 rupees. So one share of this company costs 220 rupees. Just like one slice of pizza costs 10 rupees. Okay? You can relate this with that example. So if someone wants to buy one share of Oli, they will have to pay 220 rupees. Okay? Now what is a share? A share is a unit of ownership in a company. Okay? What is a unit? If you have done your schooling, you know that we have units. The unit of length is meter. The unit of time is seconds, hours. Right? Similarly, a share is a unit of ownership in a company. Alright? So if you own one share of a company, you own a part of the ownership of that company. You don't own the company entirely. You own just a part of it. Okay? So a share is ownership in a company. Alright? Now, back to our example. The friends decide to sell 40,000 shares. People come and buy those shares. People are ready to buy and they buy all 40,000 shares. Okay? The friends get 88 lakh rupees. Now, of course, these two friends lost 40% of their ownership in the company. But then they got 88 lakh rupees in cash. Now, they have the money required to expand their business. And as planned, they open 3 new branches or outlets for 75 lakh rupees. Okay? The remaining balance of 13 lakh rupees is used for day-to-day operations of the 3 shops. Alright? Now, time goes by, and after some time, the new stores hit a profit of 10 lakh rupees per year each. Alright? That means the total profit is 40 lakh rupees, and this is per year. It is 10 lakh rupees per year per store. And how many stores are there? 4 stores. Correct? So 40 lakh rupees per year is the total profit. And 2.20 crore times 4 stores is 8.80 crores. Correct? So how did we get 2.20 crores? You can go back and check. Alright? So the current value of the company is 8.80 crore rupees. Okay? Now 8.80 crore times 60%. What is 60%? 60% is what the friends own. So 5.28 crore rupees is what these friends own now. Okay, it is what the friends own now. And 8.80 crore times 40%, which is 3.52 crore rupees, is what the investors or the people who bought the shares own. They paid 88 lakh rupees initially. Correct? But now they have 3.52 crore rupees. This is what they have now. The issue price was 220 rupees, or in other words, each share of the company was sold at 220 rupees. You know the math, right? The current price of a share is 3.52 crore divided by 40,000, which comes to 880 rupees. Alright? The price of each share of the company is now 880 rupees. Okay? It was 220 rupees, but now it is 880 rupees. You can see that if someone had bought a share of Oli at 220 rupees when they were issued, then their value would now be 880 rupees each. So you can see that they would have made a profit. Correct? So this is the concept. Alright. Now the investors who bought shares at 220 rupees each have turned them into 838 rupees. They can keep holding the shares if they think the business will do well and the value of the business will rise. But if they think that it is enough, they have held it for a long time, or if they think the company will not do well in the long run, then they can sell the shares to others. Okay? This is what happens in the stock market. There will be buyers of shares and there will be sellers of shares. If you think the company will grow, then you can buy the shares of a company. If you think it will not do well, then you can sell the shares of a company if you already own them. So this is what a stock is. A stock is a unit of ownership of a company. In simple words. Alright. So that's it for this video. I hope you have understood what a stock or a share is. In the next video, we will learn what a stock market is. Okay? But now, before we move on to the next video, I have an exercise for you. I want you to go to Google and search share price of and then the name of a company. You can type in the name of a company that you like or know. Alright. So I will say Infosys and hit enter. Okay. And when I do that, I get this result in Google. And you can see that the current price of a share of Infosys is 1445 rupees and 50 paise. It means that if I want to buy one share of Infosys, I need to pay this much rupees. Okay? This value keeps on changing, meaning it may be different by the time you go and check. But right now, this is what we would have to pay to buy a single share of Infosys. Alright? Don't worry about all these things. We will see or learn about these in later lessons. Alright? So go ahead and do this exercise and then proceed to the next video. Alright? I will see you in the next video. Till then, take care and thank you for watching.